Good afternoon, and thank you all for joining us today. This is Dan Reynolds, the Editor-in-Chief of Risk and Insurance. It's my pleasure to be moderating this panel on cyber risk mitigation and risk transfer. Concerns over cyber breaches and the cost of insuring them permeate the U.S. business landscape. One key problem for risk managers and underwriters is the recency with which the risk emerged. There's so little loss history to go on that from an underwriter's perspective, pricing the risk for one client is extremely difficult. Now imagine managing an insurance portfolio and trying to determine the aggregate risk for provider risk capital. Given the uncertainty around cyber risk and the millions in losses that can result from a breach, risk managers are in a different kind of a bind. On one side, they struggle to clearly communicate their risks to underwriters. On the other, they have boards of directors and C-suites urging them to buy coverage, sometimes with the proviso that it be the least expensive coverage available. Today's panel will offer guidance on maximizing return on risk mitigation and transfer investment with the goal of protecting the bottom line, while at the same time getting buy-in for your efforts from senior leadership. Before we begin, here are a few things to know. Be sure to have the volume turned up on your computer to hear the audio for this webinar. To ask a question about the content of the presentation during the event, you may use the Q&A panel located in the bottom right corner of your screen. We'll be leaving time at the end of the presentation to answer them. If you encounter a problem during today's webinar, please send us a message in the chat panel located in the right column of your screen. A copy of the slides and recording of today's webinar will be posted at www.riskandinsurance.com. We will email links to all attendees. We would like to thank today's sponsor, the Society of Actuaries. The Society of Actuaries, with 26,000 members, is the largest professional organization dedicated to serving actuaries and the public in the United States, Canada, and worldwide. The SOA, through research and education, advances actuarial knowledge and improves decision-making to benefit society. The SOA enhances the ability of actuaries to be trusted financial and business advisors on problems involving uncertain future events. Visit soa.org/fresh to learn more about the SOA's latest fellowship track in general insurance, property casualty. Now, a little bit about our three panel members. Our first panelist, Max Rudolph, is the founder of Rudolph Financial Consulting in Omaha, Nebraska. In his consulting work, Mr. Rudolph provides an external view of the industry best practices in enterprise risk management. He's a private investor, an adjunct professor in the finance department of Creighton University, and has served on the board of the Society of Actuaries. Welcome, Max.
Thanks, Dan. Glad to be here.
Our second panelist is Alex Kruto. Mr. Kruto is president of the Navigation Advisors in New York. He's a widely recognized expert on cyber risk, the financial consequences of cyber breaches and failures, catastrophe modeling, and advanced tools for risk analysis. His primary focus is on improving the accuracy of cyber insurance pricing and the development of practical solutions to complex risk management problems. Welcome, Alex. And our third panelist is Anthony Cappelletti, staff fellow with the Society of Actuaries and Society's General Insurance track. Mr. Cappelletti is the lead editor for the SOA textbook General Insurance Financial Reporting Topics. Anthony earned a degree in the mathematics and applied statistics from McMaster University and has 27 years experience in the property casualty actuarial field. Welcome, Anthony.
Hi, Dan. Glad to be here.
So I thought to kick off our discussion, we would look at some of the research done by Max Rudolph. Since 2008, Max has surveyed risk managers from around the globe to get their take on the risks that concern them most. Max is going to share with our listeners the results from his most recent survey. And after that, he's going to give us his take on the best practices listeners should keep in mind in addressing cyber risk. Take it away, Max.
All right, thanks, Dan. I'm briefly going to talk about cyber in the context of emerging risks, of things that are a little bit further away time frame-wise from what our daily existence of putting out fires is. So the survey that I'm going to talk from, that I've done 9 times now, talks about the role of emerging risks within an enterprise risk management and ERM context. Looking at all risks, ERM looks at all risks and their interactions. Don't forget to be thinking about questions along the way. There'll be time at the end after a round table for that. So submit them early and you'll get to the top of the list. Our survey takes it into 5 categories. So we have the economic category, environmental, geopolitical, societal, and technological. We've been doing it since 2008. We originally used a group of risks that the World Economic Forum had put together for their global risk survey each year. and we've evolved our risks since then. They have not kept theirs very consistent. We've tried to keep ours consistent, but for example, cybersecurity is one that was not on their original list, and we added it fairly shortly onto ours. So let's move on to the next slide. This shows by category the results for each of the 9 surveys across the 5 categories. What we ask, the first question we ask is for respondents to choose 5 emerging risks out of the 23. And then we roll them up into these categories. And you can see on the far right, the technological category, that's all driven by cyber. We're up to 19% of the responses now are coming from technological risks. You can also see the trend there. The trend is going up. On the economic category, you can also see that, if we're looking back in 2008 and 2009, that it was really high then, and it's dropped since then as we get further away from the global financial crisis. And that makes sense, too. When we were in 2008, 2009, anybody who was having to deal with the financial crisis really was focused in on just a few risks that would determine whether you're going to stay in business. And so as we've gotten further away from that, I think risk managers have been able to take a step back and consider some of the other risks as well. The other thing I want to point out is the geopolitical in the middle and how that bounces around. We get a little bit of anchoring bias. If there's a big geopolitical event that year, then this risk tends to spike. This has things like terrorism and regional instability are some of the risks that are part of this. So let's go on to the next slide and look at some of the individual risks. This compares the results over the last two surveys, so fall of 2014 and fall of 2015. And a couple things I want to point out here, the risks are in the order of the categories. So you can there's a link later in the slides that'll get you to the whole survey if you're interested in looking at that. But if you look towards the middle and towards the right, you get into the geopolitical risks, where the 2015 is lower, and you can see that clearly in the failed and failing states, regional instability, some of those risks. The companies that were surveyed, these are risk managers. We asked for individual responses. We're not looking for company responses. Many of the people who respond are actuaries or otherwise involved in the financial markets. And so we get a variety of sizes. We get some of the really big insurers as well as some academics and some small companies. So I think the responses we actually get are more truthful than if you were to ask companies. The companies, if you ask them if there's a problem with the risk, you're never going to have one say yes. So with this, we make them anonymous. We don't know which company it comes from, but we do ask a little bit of demographic information so we get an idea of the range. So let's go ahead to the next slide. On this one, what I'm doing is looking at the top 4 risks over the last 4 surveys. And you can see that cyber started off in 2012 at number 3, and it wasn't too far before that it wasn't in our top 5 or even our top 10. But it's gone in the last few years from 3 to 2, and now it's been our top risk in the last 2 surveys. So we ask other questions as well, and this year is the first time that cyber hit the trifecta. It was number 1 in our current risk, is number 1 when we ask people about their top 5 risks, and it was number 1 when we asked people for their top single risk. So we get a pretty good idea there of some of what people are really worried about. Let's go on to the next slide here. This one is really interesting. This, in addition to having the link to the actual report, if anyone's interested in more information about the survey, it also talks about cybersecurity by itself. Now this, you have 65% of the people in the most current survey chose cyber as one of their top 5 risks. So if we were to add up all 23 risks, the number is quite a bit higher than 100%. I think we end up getting, not everybody fills in 5, but almost everybody does. So, if we added them all up, we'd probably get 450, 470%, something like that. So, but you can see how quickly it's jumped, even as the numbers got large, because it was in our top 5 here the last few years. But even so, we jumped, 11% last year and another 7% this year. So it's just fascinating to see that, and it'll be interesting, this fall when we do the survey to see if it goes even higher, or if there's some natural peak, that there's certain people that for whatever reason don't have concern about cyber, or maybe they don't think it's an emerging risk. Maybe they feel they're managing it, and so that's one of the things that we're starting to look at in our survey. So with that, I'm going to turn it over back to Dan and let him introduce the next speaker.
Thanks, Max. And Max, I'm sure we'll be touching on some of those points later in the roundtable discussion. And Alex, I know you spend a lot of time working on improving ways to measure and manage cyber risk. First, please walk us through how risk managers might want to perform cyber risk assessment or measurement. And then, if you can, follow up with your perspective on cyber risk management techniques our audience should be considering. Alex, you with us?
Yeah, sure. I'll be glad to. Cyber risk is not just something that's on the agenda right now. It's not your risk du jour. I think it's going to be here for a long time, and it's going to continue to evolve. It's quite different from most of the traditional types of risk, and is not well understood by the majority of those who are actually exposed to it, which is all of us. It pops up in unexpected places that often have never even been considered in risk analysis. It shows up in places where risk assessment has demonstrated that it shouldn't exist. And the target data breach, for example, an event that was a big surprise to many in the risk management community and in the insurance industry, mostly because of its scale, is an example of the situation where risk wasn't supposed to exist in the area where it actually showed up, where the payment systems were thought to be separated from other systems at target, as PCI data security standards require, and yet they were not. Had that mistake not been made, the hackers who penetrated target systems through a vendor would not have been able to get to them. This risk, in all likelihood, was part of target's checklist used in risk assessment. It wasn't just overlooked, but it was considered not to exist. It was considered something that has been addressed. And this year, back in February, when the Hollywood Presbyterian Medical Center was hit by ransomware that effectively made it impossible to operate properly, affected such critical area as the ER with all the scary implications, when all of it happened, it was obvious that the hospital had not anticipated such an attack and had no idea how to respond to it. This decent-sized hospital declared a state of emergency and was able to restore its electronic medical record system only 10 days later, after paying a ransom of $17,000 in Bitcoin, which is peanuts compared to the financial losses experienced, and probably much bigger other losses that are not easily translatable into dollars. And then last month, 3 hospitals experienced ransomware attacks that, while no ransom was paid, were quite damaging in that they disrupted the operations, limited the ability to provide necessary medical care, and endangered the patients. And this example is useful in reminding us that cyber risk is not limited to the potential data breaches that involve disclosure of PII, personally identifiable information, or PHI, which is what everybody is talking about and seems to be focused on right now. We need to identify all elements of the risk and quantify them, measure them in order to understand how to manage the risk, what trade-offs are appropriate, what part of the risk is insurable, and what combination of risk management tools, with insurance being one of the choices, should be utilized. Losses from cyber events, and no matter how we define the events, can affect a wide range of areas, and any serious event will touch on quite a number of these areas, include a number of types of losses, such as those that you could see on the screen. And it is understandable why the attention is concentrated right now on compromises affecting PII and PHI, sensitive personal information. It's because of the widely publicized data breaches at Target, Home Depot, and, well, it's a long list. And not even mentioning the government agency. And we had some really bad examples there. But the second and interrelated reason is the legal requirements to disclose many of these breaches, which are becoming stricter and broader. The data breach mandatory notification laws are on the books now in 47 out of 50 states in the U.S., and it's something particularly important here. We could see that such a data breach can include obviously privacy, liability, forensic, and other investigation costs, fines and penalties, business interruption. And if you look at the list, some others. Arguably, the most important could be the reputational damage, including direct hit to brand equity. This component is very difficult to quantify, and many of the loss components in general can't be insured today. Some are uninsurable in principle. But we do have to look at the big picture and see all the financial and other consequences of cyber events, all parts of cyber risk, and we cannot just look at the part of the risk that can be insured in isolation. It just doesn't work this way. This is one of the things that are different about cyber risk. And again, it's important to point out that this is not all about disclosing data breaches affecting personally identifiable information. There are a lot of other things, and there are also types of cyber events that don't even involve an attacker. Some wounds are self-inflicted, and we could mention, for example, medical devices or something that has to do with SCADA systems that can, in theory, bring down the power grid simply because of a coding mistake. This clearly shows that we really have to look at all the different areas in our analysis. It's really the only way to be able to get the full picture. When it comes to cyber risk assessment, it is critical to do what is actually not done all that commonly, and that is measure risk, quantify it, in the sense of trying to translate consequences of cyber events into dollars. That's what I mean by quantification. And to get an idea of the probability of the many possible outcomes. In other words, to have a probabilistic assessment. And of course, it's much easier said than done. The complexity is so great, and the information available to a risk manager or to an insurance underwriter is so limited that it's easy to give up and limit oneself to purely qualitative analysis. And of course, qualitative analysis is absolutely necessary, but qualitative analysis that doesn't even get to looking at potential impact in terms of dollars is not enough. And then, of course, there is this question about the probability of the different breach scenarios as well as of other cyber events. Benchmarking doesn't really work all that well either here, but just because it's very difficult to find what to benchmark against. Every company is different when it comes to cyber. Two companies that on the surface appear to be very similar in reality might be very, very different. Let me also point out how important it is to have the right measures of risk, and actually the need to choose such measures. And we don't have time to get into discussing specific risk measures, but let me say that they have to be consistent in general, and they also ideally consistent with what is used for other types of risk in order to integrate them into the risk management framework and be able to allocate resources appropriately. We have to know which risk is bigger, and bigger how you measure it is a question of what risk metrics, risk measures you use. But if you don't use any, you really are not in a position to make any decisions. You are not in a position to choose between two different risk management approaches, two different risk management solutions that affect on the cyber risk. How do you compare them? What is the risk how much is the risk reduced after they're implemented? And part of these risk management solutions, of course, is insurance. So let's go to the next slide. It is important to have a consistent and comprehensive framework to managing cyber risk. And typically when a framework for cyber risk, cybersecurity is discussed, what's meant is the purely technical components, technical IT cybersecurity. And it's a critical component. It's a very important one, but of course it's not where it all ends. A lot depends on risk governance. A lot depends on how well people are trained. And of course, when you are looking at the financial consequences of events, you have to also consider insurance. And I would even say that not considering insurance as one of the solutions, part of a risk management solution, is right now would almost be negligent. It's really something critical that has to be considered, even if at the end it's not the best solution. And there are situations where cyber insurance is not the optimal solution. And I'm showing here the cybersecurity framework that the National Institute of Standards and Technology has developed 2 years ago for the critical infrastructure. And it's voluntary, and it may be totally inappropriate for many companies who are outside of the critical infrastructure. But the foundations of it are very useful, and you could see them here, the 5 core functions, each of which has a lot of components and tied to specific standards, but it should never be just about sort of a checklist of a compliance type where you're looking at specific standards and that's really all you do. It might be a starting point, but not more. So, cyber insurance. We have said, and we all know, it's an important risk management tool. And some of the loss types that we discussed earlier that were shown on one of the previous slides can be covered by standalone cyber insurance. But we have to remember many are not in that category. They are not insurable right now. And sometimes it's the biggest component that you cannot insure. So insurance by itself is never a solution. It's part of the solution to risk management and when it comes to cyber, but it's not the full solution. It just can't be. And the gaps in coverage is something very important to look at. And some of the gaps are created when cyber is pushed out of the more traditional coverages, as it has already happened in probably most of the policies, even if you can buy it back. And that's the gap that you are trying to fill with standalone cyber insurance, but there might still be gaps left. And there might be unusual, unexpected gaps, for example, created because of the existence of sublimits or exclusions, where sublimits might result in the payout significantly lower than what the policyholder expects in case of a cyber event. And there is even a court case right now against a London syndicate and a broker by a company that received only, less than 10% of the total limit because it got hit by a sublimit for a certain type of loss. So that's not unusual, and it's something very important to look at. And brokers, of course, can provide significant assistance here, but most brokers, not every broker has the expertise, but it's something to look at for everybody. It's not just where you could rely on others. if we look at the same issue purely from the side of insurance companies, those who assume the risk, it becomes quite interesting because the market itself is quite immature and continuing to develop. And the expectation is it's going to grow and grow fast. But the situation is that the insurance companies become risk accumulators. They assume a lot of risk from others, and usually this risk is diversified, and the more of it a company has, the more predictable the results are. It might be different in this case because of the catastrophic component. So some of those components of the portfolio, some of the risks in it may be correlated, and in unusual events, cyber earthquake, something of that kind, even a cyber earthquake that is not all that strong, could result in very significant losses to these insurance carriers. They are accumulators of risk, and the uncertainty is much bigger than some of them expect. So it's very uneven. Some carriers have a significant expertise in the area, and then there are others who might not be able to analyze the risk properly and might actually be exposing themselves too much. And this is separate from the question of how adequate the current pricing is in cyber insurance. So what's the future? What to expect? And it's the kind of risk that's changing. This is really something quite unique. It's changing dramatically, and it's obviously growing, both in terms of frequency of cyber events and their severity, as measured in dollars. At the same time, it's not just rapid growth. The risk itself is changing, and it's evolving. It's not the same cyber risk we were exposed to 4 years ago. The cyber risk 4 years from now is not going to be the same as what we face today. It's not just getting bigger, it's different. And that really affects everything. I think one point I want to make is what is going to happen, it just has to happen. Modeling will become better, and that will lead to cyber insurance pricing becoming more risk-based, where higher risk is charged higher premiums. It's not always the case right now because it's not all that easy for insurance companies to differentiate between better and worse risk, and it's why they might charge the same price. So that is going to improve, and this is definitely going to happen, and that might actually lead to some temporary dislocation in the market. Let me stop here. We can cover more of this topic in the Q&A, and I'm also happy to discuss the more technical aspects of modeling cyber risk, pricing cyber insurance, and related topics after the webinar. And this includes also the relationship of the technical aspects of risk modeling and the technical aspects of risk assessment, such as, for example, pen testing, penetration testing. So there is a lot here. Dan, let me turn it back to you at this point.
Thank you very much, Alex. So we've heard some interesting perspectives on cyber risk measurement and management, but I wanted to switch gears a little and actually touch on something that Alex touched on briefly in his presentation, looking at another part of the risk equation, and that is the risks faced specifically by insurance carriers. Carriers, of course, have their own cyber enterprise risk management considerations. They also have the task of pricing cyber risk in a way that ensures their bottom lines are secure. And Anthony, I thought I'd start with you here, if you didn't mind. How are actuaries that either work for or contracted insurance carriers helping them understand and price both their ERM risk and the risk they take on for commercial customers?
Sure, Dan. I've got some ideas to share there. Generally speaking, actuaries are highly involved in pricing insurance products and contribute to the ERM process. What makes cyber risk a challenge is that the risk evolves as new technologies emerge. I mean, we're now seeing the use of cloud computing, increased use of handheld devices, Wi-Fi, social media, the list goes on. An ERM analysis should include a formal cyber risk assessment process. Actuaries can help with this cyber risk assessment. They can quantify the exposures and estimate claims under various scenarios. Actuaries can incorporate this information into models, either stochastic or deterministic. The models can be used to analyze the trade-off between risk mitigation, risk retention, and risk transfer. Actuaries will, however, need input from others to complete construction of these models, especially from legal experts and IT professionals. As for cyber risk that insurers take on through cyber insurance policies they write, actuaries should always be involved in the pricing of policies and estimating the cumulative exposures taken on by the insurer. The difference here with pricing cyber insurance is that there is a limited data set available for pricing. It's not an annual statement line of business. There's no industry database. While the volume of business is growing, it's still small. Data for an individual insurer is generally not credible for analysis. Actuaries often incorporate alternative relevant data sets when analyzing data that's limited. Cyber insurance would be no different. There are other useful information sets available. For example, major modeling firms and reinsurance brokers have some information available, and these can be incorporated into an actuarial analysis. Another issue to consider is that cyber exposures are very unique to the business being insured and the mitigation strategies they implement. Actuaries pricing cyber insurance need to account for the individual customer's risk. They need access to reliable underwriting information. Example of the information they would need to help price the business would be number of sensitive records, what the records contain, IT security procedures, who has network access, what business continuity plan is in effect, and things like that. Actuaries also have the issue of trying to keep in mind that risks between customers are not entirely independent. Large-scale cyber attacks or a cyber attack on infrastructure may affect more than one insured in an event. There's common use of the same network equipment and software across many different businesses. Actuaries need to consider these cyber catastrophe scenarios, and these considerations would be somewhat similar to the analysis used for analyzing terrorism exposures.
All right, thanks, Anthony. Alex, did you want to add what Anthony said in that area of any additional thoughts on the aggregate cyber risk that carriers face and how that might impact price for risk managers?
Just a few words to add to what Anthony has already said. The uncertainty in general is very high, but it's particularly high when it comes to the more extreme events, those that might involve correlation among different insurance policies. Well, that cyber earthquake that could happen. And the reality is that in insurance and risk management, we tend to look at the historical data and make projections into the future based on that data. Here, the historical data is not all that valuable. Not only that we don't have it, and that's what everybody is correctly complaining about, but even if we had it, well, these cyber hurricanes, cyber earthquakes haven't really happened yet. This is all so new. So they are a real possibility, and some of those will happen. It's pretty clear. But they're not in historical data. So just looking at the historical data, it's using the more traditional approaches. It's very easy to understate the risk and not notice that catastrophic component when all of a sudden the same something big, such as a big attack affects many insurance policies, many policyholders at the same time. And that's very dangerous. The historical data that has limited predictive power and doesn't really tell us as much as about the future as we would like it to. So I would also say, well, we have to incorporate a lot of judgment here, and especially when it comes to risk accumulation. And there are some insurance companies that, at least in my personal opinion, might be accumulating more cyber risk than they think. And there are some who don't even sell cyber insurance and might not realize that they actually have an accumulation of that risk. But they might, because they have excluded it from the more traditional policies, but might have given policyholders the option to buy back that exclusion. So effectively, they are providing cyber coverage, even if it's not a standalone cyber insurance coverage. And nobody typically thinks of them as risk accumulators, but they might be in that category as well. But so there is a possibility of something like that happening, and that could lead to a dislocation in the market, and it could actually affect insurance pricing significantly. We see how it happens in catastrophe insurance, hurricanes. So prices move around very quickly if there is a big event. It's sort of a short-term perspective. And here there is even more uncertainty. So the pricing could change quite significantly. And that will certainly affect risk managers, those who are buying insurance. If certain coverage is more expensive, well, maybe it's not what should be purchased, or maybe limits should be different, or maybe at least temporarily certain types of cyber insurance are simply not available.
All right, Alex, thank you. Max, did you want to add anything on the risks faced by carriers and any insight perhaps into their pricing considerations?
Yeah, I'd just add one quick point here, Dan. For an insurance carrier, an actuary would want to consider the interactions between cyber and other risks, something like terrorism, or as we currently believe, some of the countries or militaries are involved with some of this cyber activity, and these are best considered with deterministic stress tests, where you're telling a story essentially, as opposed to trying to do something stochastically, where you're running thousands and thousands or maybe even millions of scenarios. These higher order considerations can really lead to unintended and surprising results. So it's important to think about those, and it might be to think about them even as Alex was talking earlier, qualitatively as much as quantitatively, just to try to think through the issues.
Thanks for that. I'm sorry, I interrupted you, but thank you for that.
No, I was just turning it back to you.
Okay. Another consideration that's really important in cyber risk mitigation are the perspectives or agendas of different stakeholders. In particular, we see a lot of media reports and other accounts on the pressures faced by members of boards of directors who face direct liability in the case of a cyber breach. In some cases, they might be pressuring the C-suites or the risk manager directly to purchase cyber cover without perhaps having much knowledge of the product or the considerations the risk manager has in purchasing it. And Max, I wanted to ask you, can you start us off here and give us some insight on how risk managers can navigate this admittedly tricky landscape?
Yeah, tricky is the right word. I mean, often the board member gets their information on a hot issue from the Wall Street Journal or some other media source, but they really have little depth of knowledge on the topic. So having consistent communication already set up between the risk officer and stakeholders like board members, investors, regulators, can all lead to a consistent process for considering risk. It's also important to engage thinkers that are more contrarian, so all views are not the same, especially with these emerging risks. There's very few people who have a long enough time horizon to really get a grasp of what might happen 10 years from now or longer. Most of the thought process that I run into when I go into companies is they have those fire calls that are this week, and if they get beyond their incentive comp time period, they're doing really well. So you really have to manage that. And sometimes bringing somebody in from outside, it's hard to have that internal contrarian because it ends up being the same person all the time. So sometimes if you bring in somebody from outside and just rotate those people through, they have a little bit more credibility and it doesn't typecast the individual. That's probably how I would start it off, and I'm sure we'll get some other comments.
Max, thanks. What about, Alex, anything to add to what Max gave us on that tough dialogue between the boards and the C-suites and the risk manager?
Well, I actually fully agree with what Max has said, and I do believe that quantitative analysis at this point is not at the level when we can give it sufficient credibility, and it should be performed. It's actually essential, but not instead of, but in addition to qualitative analysis, and to ideally one will validate the other. But the question of communication is really of great importance, because this risk is not limited to just one part of the organization, and it's not something that could be decided at a relatively low level. No, it actually is at the board level, and it has to affect the whole organization through risk governance, where everybody is on the same page. It's really at the very top level, senior management and the board. It's not at the level of the people who are sitting in the computer server room. You cannot delegate it, and you have to do training very effectively. Every single person at any company practically has to be trained and trained continuously. But the team effort and communication, that's something that Max referred to, is really essential here, because risk managers very often might not have a good idea of what the risk is. It's really a very technical cybersecurity IT issue in many cases. So this direct communication is very important, and I think it doesn't exist at most places.
Alex, thank you. Anthony, did you want to add anything on that topic of that landscape and the chemistry between the risk manager, the board, and the C-suites?
Well, I mean, I agree with what my fellow panelists have said here. I'd just like to add that it's important that the risk manager gets input from various different areas. They need input from IT, actuarial, underwriting, legal, public relations, brokers, and consultants, and utilize the strengths and weaknesses of each of those viewpoints to come up with a proper strategy and approach.
Okay, great. Thank you. Another dynamic that we've touched on, but which we could dig into a little deeper, is the tension between financing risk mitigation and the allocation of resources to purchase cyber insurance. Alex, why don't you start us off here? We know we have insurance as a valuable backstop, but can you give us some guidance on the ratio of resources that might go into cyber risk mitigation versus risk transfer, and how a risk manager can create buy-in or demonstrate the return on investment for his or her strategy in this area?
Dana, it's actually a very practical question that some risk managers have to deal with right now. And I often see the traditional risk management function that includes purchasing insurance being completely separated from the technical cybersecurity function. There's some technical cybersecurity IT people not even believing in the value of insurance and insisting that the money paid in insurance premiums would be much better spent on improving the technical defenses and some also say training. Doing that is important, but not instead of buying insurance. And this friction, of course, is a problem. And I don't think there is a magic number ratio of funds spent on cyber insurance as opposed to mitigating financial risk due to cyber events in other ways. I don't think it exists. In some cases, the best risk management solution may not even include insurance, and I'll be the first to admit it. It depends on what risks a particular company is exposed to, what threats it's facing, the vulnerabilities, the cybersecurity posture, the maturity level of the company's cybersecurity, and a whole host of other considerations that are involved in risk assessment. And it is necessary to analyze the whole risk and then decide on the best combination of risk management tools, one of which is cyber insurance. the best to the one that's most appropriate given the risk, but also taking into account, as Max said, other types of risk in the enterprise risk management framework, and also taking into account the risk tolerance of the company. Looking at all the options is important, and it's always a trade-off. So it's not some kind of a specific ratio. That's where quantification of the kind we discussed comes into play. It allows us to choose the right trade-off, the most effective, comprehensive risk management solution. And after all, insurance itself is one of the risk mitigation tools. But it goes without saying that insurance is never a substitute for improving cybersecurity. Part of the question that you asked is how to justify a recommendation when it's formulated, how to present it to the decision makers. And it's tough. It depends on how it works at your company, what the reporting arrangements are, how actively the decision makers are involved in risk analysis, how well they understand cyber risk. And the friction with the people who say the same amount of money should be spent, taken away from cyber insurance premiums and be spent on improving cybersecurity, well, that whole question, the way they approach it, doesn't really make all that much sense to me, because it's not necessarily a fixed dollar amount in the budget that then has to be split between technical cybersecurity, IT, buying insurance, training. It's not like that. It's not necessarily a predetermined amount. But how to justify a particular risk management solution or one of its components, such as buying cyber insurance, depends very much on whom you have to convince. And if it's the senior management, and in some cases even the board members, well, you have to use language they understand and the risk measures that they would really be able to take seriously. And the ROI measure, which actually is appearing more and more in discussions of cyber risk, the way it's typically defined is not really the best approach, even though that's how it might come from the IT department who wants to justify taking money from buying insurance and deploying the same funds for improving cybersecurity on the technical side. It's not like that. There are ROI, or sometimes return on security investment, is generally the kind of measure that's based on the expected, on the average, on the mean. And here we are not dealing with results that are relatively predictable. The variability of outcomes is not limited. We are talking about potentially catastrophic risk. So that whole ROI framework doesn't work so well, even when it's modified. And ultimately, it's a risk, and you justify it the same way you would justify purchasing insurance for any other types of risk. It's not about making money from that particular transaction. No, it's a cost. It's an important cost because when you buy insurance, because that's what reduces your risk. And it's just important to be able to compare the different alternatives and to show that your solution is better. What is the remaining risk after buying insurance and improving cybersecurity? Is the risk level acceptable? Can the same be done cheaper using a different combination of risk management tools? If there are numbers to support your analysis, that's the greatest argument and best justification. That's how I look at it. And it certainly helps to show that some of the potential cyber event scenarios are pretty bad, and how in those scenarios insurance, together with other risk management tools, reduces the impact. And I know it's how it starts in many cases. Show the board some of the really scary scenarios to make your case. And I know that creating fear, uncertainty, and doubt is often very effective. But it's not really what I recommend personally. But it makes sense to show some of those bad scenarios. It's important. Some are not aware of it.
Pardon me, I just want to jump forward here a little bit because we're running long.
Yeah.
I want to touch on the area of reputational risk before we move on to your takeaways and any questions from the audience. We know we can mitigate cyber risk. We can buy insurance as a backstop. but there's still the reputational hit a company can take in the event of a breach. Max, in your work, what are you advising clients to do to minimize the impact of reputational exposures in the event of a cyber breach?
Yeah, real quickly, I have them look at gross exposure, meaning before mitigation efforts and before insurance, and point that out that for reputational risk, it's really the same as their net exposure after those mitigation and insurance techniques for the reputational risk. So you want to keep that in mind, as you balance that, what Alex was just talking about, balance that mitigation effort versus the insurance. Although, the cyber expert from an insurer can bring best practices to the table. This is a game of leapfrog. So it's not a project, it's a process. It's something that you need to continually revisit and come back, because if you think you're putting in a solution, any solution is temporary, and you need to constantly be tweaking it.
Max, thank you. Anthony, anything on the topic of reputation risk and some considerations?
Well, yeah, I do. Mitigation strategies can't cover everything, and they can't foresee previously unknown attacks. So it only goes so far. But to protect reputation, I really think it comes down to a company being prepared to deal with the outcome of a loss, and by that they need to develop post-event strategies before they occur so they can deploy the right public relations messaging immediately and inform customers and others that are affected by the event. Really acting immediately is the key. Without a plan, valuable time is lost, and it risks damaging the company's reputation further.
Anthony, thanks. I'm going to jump ahead a little bit here, Alex, and ask the panel to get to their key takeaways. And Anthony, if you could please, before we get to questions from the audience, what are some just three things that you would consider key takeaways on this topic?
Well, there's certainly a lot to choose from, but first of all, I'd say all companies need to have a cyber risk assessment as part of their ERM process. This applies to both large and small companies across all types of business. Nobody is immune from cyber risk these days. The assessment has to address the risks with appropriate risk mitigation strategies and the possible use of insurance.
Anthony, thank you. Max, what would be your key takeaways?
Yeah, I've got three, Dan. First one would be to be aware that the time horizon for any emerging risk, and cyber is certainly that, even though it's somewhere in the middle between emerging and emerged, but it's long, and take the time to consider these emerging risks on a regular basis, not just on an ad hoc basis, when all of a sudden there's some article in the Wall Street Journal or the New York Times. The second one would be to make sure you make time for contrarian views. Listen to these types of people and encourage them, even when they seem crazy. Sometimes the crazy ones are the best. And sometimes you can get that if you look for a broker that can help you understand these risks and understand and help you balance that mitigation versus financing and insurance. And the third one would be the stakeholder communications with the risk officer must be consistent and well thought out. You want to tell a story with a combination of qualitative and quantitative methods and thoughts, and don't overwhelm your stakeholders with numbers when a picture is available.
Great. And Alex, how about your takeaways, your key takeaways?
Well, to add to what has already been said, let me say that cyber risk can be measured. It can be modeled. It can be properly managed. And it should be done. Yes, the uncertainty level is a lot higher than what we would like it to be, but it doesn't mean that we shouldn't even try to assess the risk in quantitative terms. Not instead, but in addition to other types of analysis. It's just simply important to remember that the uncertainty is high and not to put too much trust in any modeling results, but these modeling results could have a lot of value. The second point is that corporate risk governance is critical. The responsibility for managing cyber risk is at the top with the CEO and the board level, not simply delegated to the technical people to be handled in the computer server room instead of the boardroom. This risk affects all areas of the organizations and should be reflected and reflected properly in corporate risk governance. And then one more point that Anthony referred to is that it is important to shift the focus of cybersecurity from exclusively perimeter defenses, trying to prevent intruders from getting in, as important as it is, and to shift this focus to preparing to reduce the impact of cyber events, assuming that the intruders are already in the system, that the events have already occurred or will occur. And that is what's happening at most companies, but not every company. And that's a very important component. Thank you.
Alex, that's a great point. So we do have some questions from the audience, and the first one was for Max. Max, it had to do with your survey. The listener wanted to know, can you give us more information about what size companies were surveyed, what the range was?
Yeah, it was, as I kind of saw that one as we went along. It's an individual survey, so it's anonymous. So we get a little bit more honesty out of our respondents than I think if you asked a company if they were struggling with the risk. The answer would always be no. But we get a variety of companies, anything from small companies to extremely large, companies certainly that we've all heard of. We have demographics around the world, but primarily North American based, and primarily to this point, the risk managers that respond tend to be financial experts as opposed to military or or cyber experts for that matter. But hopefully we'll have Alex fill it out this year.
All right, Max, thanks. Here's another question I thought would be of value. What are the panel's thoughts on restricting insurance companies to collect less personal data as a risk mitigation strategy? Anyone want to take that one?
Well, it's Alex. Let me just touch on it. We're all actuaries here, all three panelists, and of course, as numbers people, we would like to have as much data as possible because it could be useful in the analysis. It could be useful in a number of different areas. But when we do it, it also creates additional cyber risk. We have this personally identifiable information. It could be stolen. It could be accidentally released. And we don't want that to happen. So it's a trade-off. But if we are talking about restricting the ability, I guess the question is more about the legal restriction. And I don't believe that right now insurance companies are, at least your typical insurance company collects more information than is necessary from policyholders. It might be the question of what's done later with that information or when it's destroyed. It's this big topic of who owns the data. But I'm certainly not going to recommend any legal restriction, which I think is the implication here.
Right.
I wouldn't recommend any additional regulations.
All right, terrific. Maybe one last question quickly before we have to sign off. Is there a type, does the panel think there's a type of cyber breach or cyber risk for which buying cover, you could say, would be a better option?
But then it again implies that the question that we sort of have a choice. We do either this or that. It's either cyber insurance or it's something else. And I think it's always a comprehensive risk management approach that cyber insurance is included in that approach, of course. But of course, there are situations where it's quite useful to have a cyber cover. And the type of policies that are being marketed right now, a lot of them are focused on breaches of personally identifiable information. And they include interesting components, such as providing a breach notification as necessary, providing painful legal costs for forensic examinations, for a whole a lot of other things, and it's useful to companies who have a lot of that type of data that potentially is at risk. And maybe another thing is that could be useful is sometimes they also provide services or really push you towards specific providers, legal services providers or forensic examinations providers, and to companies that might not have that expertise internally or don't have a legal law firm with this expertise on retainer, that might actually be useful. And then, of course, for some others, it might not be.
Alex, thank you. Unfortunately, that's all the time we're going to have for today. We would, again, like to thank our sponsor, which is, as I mentioned earlier, the Society of Actuaries with 26,000 members, the largest professional organization dedicated to serving actuaries and the public in the United States, Canada, and worldwide. The SOA, through research and education, advances actuarial knowledge and improves decision-making to benefit society. The SOA enhances the ability of actuaries to be trusted financial and business advisors on problems involving uncertain future events. Visit SOA.org/fresh to learn more about the SOA's latest fellowship track in general insurance, general property casualty insurance. Thank you, Max, Alex, and Anthony, for some great content. I really appreciate your time today. And thanks also to our attendees for their attention. And have a great day, everyone.